Greetings, Ed Yardeni here. It's July 18th. Time just continues to fly. I hope you had a great weekend. It's been nice out here in Long Island, a little rainy today, but it's been kind of necessary here for the grass anyways. We've seen our grass turn brown, so we're kind of welcoming the rain. Lots to talk about, obviously. Market's been doing very nicely since it bottomed on June 16th. Oh, by the way, there's Max. This time Max decided to take a little snooze on the couch. So you let me know in the Q&A if the snoring bothers you or not. But it's he always finds these conversations very soothing. Hope you do as well. Again, lots to talk about. The market bottomed at this a freaky number of 3,666 on June 16th. The reason that's weird is it bottomed at 666 on an intraday basis back in March 6, 2009. So it's interesting to see that the bottom so far is 3,000 points above the bottom in the S&P 500 back in 2009. Coincidence or Da Vinci Code? I mean, we'll see. But what is interesting is from a fundamental standpoint, is we have seen some improvements in the underlying fundamentals that influence valuations and earnings. On the valuation side, we've seen the bond yield has dropped from about 3.5%. I think it was on June 14th that it peaked. So just about at the same time that the S&P 500 bottomed. And so it's down from 3% to 3.5% to 3%. So that's encouraging. Also encouraging is we've seen a significant drop in commodity prices. Some of those indexes actually peaked more in May than they did in June, but they've been coming down. We've seen the price of copper coming down dramatically. The price of oil is hovering around 100. It had been as high as 125. And so that's somewhat encouraging. And the price of gasoline has come down quite a bit, enough to maybe boost consumer confidence a little bit. It seems that consumer inflationary expectations are very much affected by what they see on a daily basis passing by gasoline stations or pulling into the gasoline stations. And what they've seen is a tremendous surge in gasoline prices. Now they're going to start to see that it's come down some. I think some of it is consumers reacted to $5 a gallon by cutting back on consumption. And I think some of it is the supply is there. We certainly, one of the big differences between now and the 1970s, and I admit it certainly looks like the 1970s in lots of ways, though the 1970s on fast forward. But one of the things that's different is we haven't seen any gasoline lines so far. So there isn't this perception that you've got to fill up your tank and stand in line to do it. The gasoline is available, just more expensive. So I think that's an interesting difference. But one of the issues that comes up here, obviously, is since we made that interesting low on June 16th, might that possibly be the low for this bear market? I know that's a stretch. Everybody's feeling pretty bearish about things. So who wants to think about the possibility that this might actually be the bottom when there's so many people talking about this thing can go a lot lower, 10, 20% lower. And their arguments are legitimate, they're credible, and there certainly is a potential for the market to go lower. But before we kind of review those arguments, let's consider some of the arguments to be made for the potential that June 16th at 3666 made a low. It may not necessarily be a major bull market low. In other words, we don't have to see the S&P 500 go straight up from here. That seems extremely unlikely. I mean, there's no credibility to the notion that we just go straight up from here. But maybe we go sideways for a while, meander, if you will, around this level on the downside, and maybe 4,000 on the upside for a while as the market tries to sort out which way the economy is going, which way inflation is going, what the Fed's going to be doing once it does what we've already discounted, namely 275 basis point hikes in the Fed funds rate at the July meeting and then at the September meeting. So then we could meander for a while, a few months, maybe through the end of the year. But I think we'll get out of this morass and we'll see that the market does in fact move to new highs next year. So we may have to wait a while to confirm that we started a bull market here, because none of us are going to really have confidence in that unless we make new highs, would be my thinking. But let's discuss here what is in favor of thinking about a low on June 16th. There's some indications that inflation is peaking. On the inflation front, we've seen commodity prices come down. The average hourly earnings measure of wages, that seems to be moderating somewhat. The New York Fed survey that just came out for July did show a decline in delivery time, suggesting that supply side disruptions are abating quickly. And at the same time, it showed that prices paid and prices received indexes have come down somewhat in the New York district. It's only New York, and there's 4 more Fed districts that will report their business surveys that we want to be apprised of, be attuned to. And then we'll average them all together and we'll get a pretty good leading indicator of what the National Purchasing Managers Indexes are likely to show in July, but that would be first thing in August. Inflationary expectations, they're still elevated, but as we saw in the Federal Reserve survey, Federal Reserve Bank of New York survey, the longer term expectations have come down some. The 1-year expectations are still elevated, but seems like consumers are buying into the idea that the Fed's going to tighten and that may bring inflation down. With the rest of the Fed, I think the market's pretty well discounted 2 rate hikes, as I said before, 75 basis points each. And that would get us up to a range of 3.25%, 3%, 3.25% by late September after the FOMC meeting. That might be it. I know that there are people talking about 4, 5, 6%. Maybe not that many people talking about 5 or 6, but certainly 4s. The idea being that the Fed's going to have to be a lot more restrictive, go a lot higher above the so-called neutral rate in order to slow the economy down, maybe even cause a recession as a only way to really bring inflation down. However, I would point out that we also have an ongoing process here of quantitative tightening. The Fed is letting its balance sheet roll down, mature. And as that happens, that's got to have some sort of tightening impact. And I think it's one of the things that's kind of been spooking the market for the first half of the year is the uncertainty of just what QT entails or is equivalent to in terms of tightening. I got to believe it's at least a 50 to 100 basis point increase in the Fed funds rate. So that's the bad news. The good news is that means that the Fed funds rate doesn't have to go that much higher. The actual Fed funds rate doesn't have to go much higher than 3.25% to translate into something like 4.25%. If you take my gut assumption that QT translates to, let's say, 100 basis point increase in the Fed funds rate in effect. So there's a lot of tightening that's been going on. We've seen it in the mortgage market. We've seen that having an impact on housing. And we've seen that on consumer durables spending. People are cutting back on that. And so all in all, the economy is showing that it's barely growing, if at all. I mean, we know that it actually fell 1.5% in the first quarter, and the Atlanta Fed's model is tracking at something like -1.5%. So the first half looks like it's going to be a negative, and it's very likely that we'll have no growth or slightly negative growth in the second half of the year. In that case, I think we can view that as a mild recession, view it as a growth recession, view it as a mid-cycle slowdown. We had similar mid-cycle slowdowns in the mid-'80s, mid-'90s, and mid-2010s, and we may very well experience that once again. And in my opinion, that may be enough to again, put downward pressure on inflation, and we're still looking for inflation to moderate from 6 to 7% in the first half of the year to 4 to 5% in the second half of the year, and then 3 to 4% next year. The chances of getting to 2% are slim to none, in our opinion, at least through the end of next year. And that's, of course, barring a really hard landing recession, which is not our forecast at this point. Another thing going for the market here, I think, is TNEC. There is no alternative country. We've seen the dollar is very strong. Obviously, that's a negative for earnings. But on the other hand, we're seeing a lot of capital inflows coming into the U.S. as the U.S. is viewed as a safe haven for global investors. It's a crazy world out there. The geopolitical uncertainties and setbacks in Europe certainly are disturbing in the Ukraine. And of course, a lot of uncertainty about the Chinese economy. We know the price of copper is going straight down, which suggests that China is not doing very well. I guess another factor for arguing that perhaps just maybe the June 16th was a low was there's a lot of bears out there. Bearishness has been intense for the past 11 weeks. The bull-bear ratio has been reading under 1.00. And that suggests that the market's got lots of bears and not too many bulls. And maybe the last week was kind of an interesting indication of that, because the CPI and PPI numbers were disappointing. They were disturbing. And yet the market all in all was basically flat. And on Friday, it was actually up pretty nicely on weak economic indicators. Retail sales were down and production was down. Well, let's look at the charts, and then we'll use that to make the case that the bears have been making, and acknowledge the fact that they're making valid points. It's not like they're completely missing something. They've been obviously on the money so far this year. So here we have the S&P 500 in a bear market, down 23.6% through June 16th. And the question is, where do we go from here? The answer is sideways, in my opinion, but we'll see how things unfold. Stock price index, another way to look at it. Again, we bottomed here at 3,666. Still a downward trend here. So arguably, if kind of fail around here and the bearish case looks more credible again, then we could certainly take that level out. And then the next level of support, I guess, would be something like maybe around 3,400, which would be the level that was the record high right before the pandemic hit. Certainly on a valuation basis, we've seen a tremendous amount of re-rating here. The PE here is 16.1. On June 16th, it got down to 15.3. Could it go a lot lower? Absolutely. In a recession scenario, a hard landing scenario, it could certainly go lower. Mid caps and small caps are especially cheap, as you can see from these particular charts. So on the inflation front, I made the case that there's some signs of moderating inflation. Durable goods inflation has been moderating. You can see that the 3-month at an annual rate is even more moderate. So that's a 3.7%. New car prices still kind of sticky to the upside. Used car prices have come down quite a bit, as you can see. Furniture and bedding, the 3-month is lower than the 1 year, suggesting that there's disinflationary tendencies in that area. And major appliances, not surprising given what's going on in the housing market. We're seeing that in the past 3 months at an annual rate, we're actually down 7%. The producer price index, we didn't get much relief on the inflation front when you look at the finished goods in this top panel. In the mid panel, you can see that we have the core inflation rate moderating some. This is sort of pipeline inflation in the PPI. And then here's the crude goods inflation rate. And you can see that the crude goods inflation has come down on a core basis. It's the headline, it's the food and energy that continues to be problematic. But we did see a sharp drop in agricultural and energy prices in July. So we are likely to get some good news in the next batch of inflation numbers. Here's that Goldman Sachs commodity index looking kind of toppy. And here's that New York Fed survey that I mentioned. As you can see, the delivery time has come down dramatically. So that's a clear indication that supply chain disruptions are easing. And then the prices paid and prices received indexes are coming down. I wish there was a lot more to point out, and maybe there will be right up ahead here looking at the business surveys, but right now that's about as good as it gets on that front. With regards to the Fed, I mentioned the QT issue here. Again, as we think about how high the Fed funds is going to go, let's not forget that QT did get started here in the middle of the year, and that's got to have some tightening impact. And certainly this is one of the reasons that we've seen the stock market take a dive. The market anticipates things by about 6 to 12 months, and it anticipated not only that the Fed is in fact going to be raising the Fed funds rate, but that QT is coming. So again, I'm kind of looking at this situation as a mid-cycle slowdown. And so far, looking at the forward earnings data, we did the year-over-year percent change in forward earnings in nominal and real terms, and they don't differ much except now where you can see that inflation's had a big impact on creating some divergence. But overall, it shows that we're still seeing a slowdown in the growth rate on a year-over-year basis in forward earnings, reflecting analyst consensus expectations. And maybe that's about to accelerate dramatically to the downside. We don't think so. We think analysts do have to lower their numbers, but not in a drastic fashion, again, consistent with a mild recession. You can look at that chart on your own. It just shows the same thing versus bear markets instead of recessions. So again, the bears, I think, are arguing that inflation is going to be much more protracted. It's going to require the Fed to raise interest rates a lot further. That we're going to get a Volcker moment out of Powell, where he has to just let interest rates rip to the upside with the intention of and recognition that it's going to cause a recession, as the Fed comes around to believe that the only way to bring inflation down is with the recession. Again, that's the bearish case. Another more credible view, not more credible, but another concern that the bears have, and I share with them, is the notion that Europe could be in a really bad recession later this year, going into the winter, if in fact the Russian gas gets shut off. I would think that the Russians would like to keep the gas going in an effort to get some revenues out of their adversaries in Europe. It's a very strange situation that we've gotten ourselves into, or that the Europeans have gotten themselves into. But that is something to worry about. And then, of course, there is the issue of why do we care about recessions? Because that's when analysts scramble to slash their earnings, and as they do so, that depresses the market's expectations of earnings and valuation as well. So what's the economy doing right now? Again, it was kind of interesting to see the market do so well on Friday, when inflation-adjusted retail sales has actually been down 2 months in a row. I think it was down 0.3% real in June, and then down 1.1% the month before in May. And then industrial production, the manufacturing is down 0.3% per month in May and June. So that's looking toppy. And both of those are incorporated into the index of coincident economic indicators, which hit an all-time high in May. So there's certainly no recession through May, according to the index of coincident economic indicators. But there's some signs here that they're starting to give in a bit in June, and that being the case, that the index of leading economic indicators are signaling that may be the case, because they've been falling for 3 months in a row. And there's a good chance that the June numbers for leading indicators will be down as well. This is just the sentiment number that I pointed out is readings under 1.0%. Here's a chart to finish this off, showing our expectations for earnings, $215, $235 this year and next year. Mild recession this year, so earnings are flat, and then a recovery next year. And you can see that the analysts are at 228, 250. And so we're expecting that they're going to be lowering their numbers as we get through the second half of this year. Well, I covered what I wanted to cover. Let's see what you're interested in that I might not have covered. So let me go to the Q&A here. What are you looking at to gauge the quality of earnings for second quarter as they come in? Well, you know, we focus on S&P 500 operating earnings, basically using the conventions that IBES, Refinitiv used to be Reuters, that data that we look at. And so we'll be monitoring that. I showed you that last chart. That's the data we'll be looking at. Quality of earnings is always, it's a very subjective issue, and we kind of stick with the numbers and see where they're going as reported. In the past, there were big controversies about reported versus operating earnings and whether write-offs were legitimate or not. But we're going to go with what we think the market discounts, which is operating earnings, and as compiled by IBES Refinitiv, reflecting analyst consensus expectations. What are your thoughts on high yield bonds? We've seen the spread between high yields and governments widen some. It hasn't widened the way it typically does in a recession or a credit crunch. Still don't expect to see much in the way of a credit crunch. Businesses, a lot of them refinanced their debts over the past couple of years at record low interest rates. But all in all, you know, I think we're still looking at a weak economy. We're still looking at some companies that are going to be facing margin pressures. So it's hard to get very positive about high yields here. So all in all, I think I'd stick with treasuries and high quality corporates. Okay, so that was from Kevin. Scott has a question. Can you speak to Jeremy Siegel's comment in this weekend's Barron's? He said, we are not in the 1970s because the Fed stopped the growth of the money supply this year very dramatically after growing it more than any other year in 150 years. Compared to the 1970s and 1980s, in which the Fed did not stop the growth until Paul Volcker came in. I've heard Jeremy make that comment before when M2 took a dive. I think it was in April and May, and now in May. I think that's the latest data that's out there. He got very, he made a big deal about it. I don't see it as that big a deal, quite honestly, because these declines in the M2 follow this, you know, $3 trillion increase during the pandemic. We had this huge increase. And now, of course, QT has an impact on the money supply. So he's right. I mean, the Fed has had some impact here on slowing the money growth, though QT started in June, and I don't think we have June M2 yet. I think we have April and May. So I think there's something to this case, but he's giving it more weight than I would give it in terms of the difference between now and the 1970s. Doug, why are small cap stocks so much cheaper than the rest of the investment universe? That is a great question that I've been puzzling over, because I've been thinking that they are awfully cheap and attractive relative to large caps, and yet they keep getting cheaper. Of course, one of the reasons that their valuation multiples has gone down is because the analyst earnings expectations have kept going up. So you've had this dichotomy, as we've seen in the market, generally speaking, between the analysts and the investors. And I've said that investors are on Mars and analysts are on Venus. They're just completely different planets. But the earnings expectations for small cap, mid cap have actually gone up faster than for the large caps, and that's contributed to the weakness in the valuation multiple. But of course, the prices have also come down, and that's been an issue. Perhaps it's all because the market's anticipating a more severe recession, and when you have a lot of risk off, nobody wants to be in small cap, mid caps, even though their fundamentals look fundamentally good to me. Okay, William, how would a recession in Europe export deflation to the U.S. which dominoes fall first? Well, the clear path would be through trade. So if European economies fall into a significant recession because of the energy crisis they're facing, that would depress our exports to Europe. It would depress China's exports to Europe. Everybody's exports to Europe would be depressed. And I suppose the currency could also have an impact. We've seen a very weak euro, very strong dollar, and that we know is going to have some negative impact on earnings from overseas for American companies, but they're also going to be selling less in Europe. Another possible transmission mechanism for trouble there, causing trouble here, is of course that a bad recession over there creates a real problem in the financial markets, with credit spreads widening dramatically, and maybe triggering a banking crisis or some credit crisis that then kind of spills over into our capital market. So I think this is an important issue. We'll see. Right now, the Russians claim that they've shut down the gas supply to Europe for maintenance purposes of the pipelines, and everybody's kind of waiting to see what happens here in a couple of weeks, whether the gas will be flowing again. But yeah, as you know, the Europeans are scrambling to find alternatives, whether they'll find enough in time, and whether they'll be able to fill up their storage facilities in time for winter is another issue. Take one last question here from Bing. What's your opinion of severe global recession depression precipitated by global housing bust, most notably Europe, Canada, Australia, parts of the US? That's a good one. I think there is a housing bust in China. I think you mentioned everybody but China. I think China's got the biggest housing bust right now. It's, I think, probably as big as the one we had here in the United States. They're just maybe better at managing it. You know, if the Chinese were running the system in 2008, 2009, maybe they wouldn't have let Lehman go under, and they would have, you know, kept it going. But that certainly is what kind of brought everything to a calamitous conclusion in the great financial crisis. But China's got some very significant issues in the real estate market, and you're right. Real estate markets are extended, overpriced, overvalued in lots of other parts of the world, and that could very well lead to a global recession of housing recession. Maybe that's what copper is telling us right now, is that's indeed what's in store. I mean, you've got central bankers around the world raising interest rates, mortgage rates are going up, and so that's certainly taking a lot of the enthusiasm out of buying houses. But again, that kind of gets me back to TNEC. There is no alternative country. That when you look around the world, look at things like the housing market, I mean, I think we can see home prices fall here without having a real calamity the way we did in 2008, 2009. They just aren't the kind of derivatives and leverage in housing that there was back then. Not that it wouldn't hurt, not that it wouldn't be a source of weakness. But again, it all adds up to me to an environment of slower economic growth with lower inflation and on balance, I think that should stabilize the market instead of destabilize the markets. But stay tuned. We're all in this together, and we'll see how things unfold. Thanks all for joining in. Thanks for your questions, and let's do this again next week.